Uber became one of the most famous companies on earth while losing billions of dollars almost every single year, and somehow that never stopped investors from pouring more money into it because Uber was never really selling transportation. It was selling a fantasy about the future, a fantasy about disruption, a fantasy that technology could rewrite the laws of economics themselves. And for over a decade, Wall Street desperately wanted to believe that fantasy was real. At first glance, Uber looked unstoppable. The app was elegant, convenient, and addictive in exactly the way Silicon Valley products are designed to be. Tap a button and a car appears within minutes. No awkward phone calls, no cash, no waiting in the rain trying to flag down a taxi. The experience felt magical compared to traditional transportation systems that looked old, fragmented, and inefficient. Consumers loved it almost immediately, and that was exactly how Uber planned to conquer the world. Because Uber understood something extremely important about modern capitalism. If you can make people emotionally dependent on convenience before the economics collapse, they will continue using the product long after the original business model stops making sense. But behind the smooth interface and sleek branding, Uber had a massive problem from the very beginning. The company was losing money on nearly every ride. In many cities, customers were paying less for trips than the rides actually cost to provide. The cheap prices weren't the result of technological efficiency. They were subsidized by investor money. Every discounted ride, every promo code, and every artificially low fare was effectively funded by billions of dollars from venture capital firms that believed Uber was not simply building a taxi company, but creating the future infrastructure of transportation itself. That distinction mattered because traditional taxi businesses are not particularly attractive investments. They are local, heavily regulated, low margin, and operationally messy. Silicon Valley needed Uber to look bigger than that. Much bigger, so Uber didn't market itself as a transportation company. It marketed itself as a technological revolution. Travis Kalanick, Uber's co-founder, pushed the image aggressively. Uber wasn't replacing taxis according to the narrative. It was transforming urban mobility, disrupting outdated systems, and building a platform that would eventually dominate global transportation at a scale no taxi company could ever achieve. Investors loved this story because the 2000s were dominated by one obsession: growth at all costs. Silicon Valley entered an era where profitability became almost irrelevant compared to market domination. Companies were rewarded for burning money if they could convince investors they were capturing the future. And Uber became one of the most extreme examples of this philosophy ever created. The company expanded into hundreds of cities across the world at a speed that looked almost irrational. It launched before regulations existed. It fought governments openly. It ignored local taxi industries. It operated with the mentality of a military invasion rather than a normal business expansion. And the strategy worked. Consumers embraced Uber because it solved immediate frustrations. Drivers joined because the early incentives looked attractive. Investors kept injecting billions because user growth exploded quarter after quarter. The company became a symbol of Silicon Valley power itself, aggressive, fearless, and convinced that technology could bulldoze any obstacle standing in its way. But underneath all the hype, the economics remained deeply broken. Uber's biggest hidden problem was labor. Traditional tech companies scale beautifully because software is cheap to replicate. Once a social media platform is built, adding millions of new users costs relatively little. But Uber was not pure software. Every ride still required a real human driver, a real vehicle, real fuel, insurance, maintenance, and traffic. Uber tried to present itself as a tech platform rather than an employer because the moment drivers were treated like employees instead of independent contractors, the entire business model became dramatically more expensive. This is why Uber fought so aggressively against labor regulations around the world. The company's survival depended on maintaining a workforce without traditional employee protections. Benefits, healthcare, paid leave, overtime, and labor guarantees threatened the economics of the platform itself. Critics argued Uber was not really disrupting transportation, it was disrupting labor laws, and in many ways, they were right. At the same time, Uber was trapped in another brutal reality: competition. Because transportation apps are not naturally monopolistic in the same way social media or operating systems are. Consumers can switch between Uber, Lyft, or local alternatives almost instantly. Drivers can do the same. There were very few true lock-in mechanisms. That meant Uber constantly had to spend enormous amounts of money on incentives, discounts, and promotions just to maintain growth and market share. And then came the deeper problem nobody in Silicon Valley Valley wanted to admit. Uber's entire long-term vision depended on something that didn't exist yet: self-driving cars. For years, autonomous vehicles were treated almost like salvation inside Uber's business model. The logic was simple: human drivers were expensive and unpredictable. Remove drivers, and suddenly Uber transforms from a low-margin transportation company into a massively profitable automated logistics network. Investors became obsessed with this possibility because it solved the company's biggest weakness instantly. But there was one problem: self-driving technology turned out to be far harder than Silicon Valley promised. Waymo, Tesla, Uber, and countless other companies spent billions trying to solve autonomous driving, yet reality moved far slower than the hype. Fatal crashes, regulatory issues, technological limitations, and unpredictable urban environments exposed how difficult full automation actually was. Uber had built enormous portions of its future valuation around a technological breakthrough that remained uncertain for years. Meanwhile, the financial bleeding continued. By the time Uber went public in 2019, the numbers looked almost surreal: billions in annual losses, massive operational costs, endless spending. Yet Wall Street still pushed forward because the market had become addicted to growth narratives. Investors were no longer simply buying companies, they were buying dreams about the future, and Uber represented one of the biggest dreams of all: the idea that technology platforms could dominate entire industries before ever figuring out profitability. But public markets are colder than venture capital. Private investors tolerate fantasy far longer because they are betting on future exits. Public shareholders eventually demand results. And once Uber became a public company, the pressure intensified immediately. The company started cutting costs, reducing incentives, and increasing prices. Suddenly, consumers who had grown accustomed to artificially cheap rides began noticing something uncomfortable. Uber wasn't actually cheap anymore. In many cities, rides became shockingly expensive during peak demand. Drivers complained their earnings were shrinking while the company still struggled financially. Customers became frustrated with surge pricing. The illusion of infinite growth started colliding with economic reality, and that's when people began asking the dangerous question Silicon Valley had spent years avoiding. What if Uber was never a revolutionary business model at all? What if it was simply a heavily subsidized transportation company temporarily disguised as a tech empire by investor money and futuristic storytelling? Because underneath the algorithms, apps, and branding, Uber still faced the same brutal economics transportation companies have always faced. Moving humans through physical space is expensive. Cars depreciate, fuel costs money, drivers need compensation, traffic wastes time. Real-world logistics do not scale like software. This is the hidden truth behind much of the modern tech economy. Many so-called disruptive companies did not initially succeed because they invented profitable systems. They succeeded because ultra-low interest rates and endless venture capital allowed them to burn enormous amounts of money while capturing market share. Investors tolerated losses because they believed dominance would eventually create profitability later. Sometimes that strategy worked, sometimes it didn't. Uber survived largely because it became too culturally embedded to disappear. The app fundamentally changed urban transportation behavior across the world. Millions of people integrated ride-sharing into their daily lives. Entire cities adapted around the convenience of on-demand transportation. Even if the economics were messy, the behavioral shift was real, and that may be the most important lesson in Uber's story. Modern capitalism increasingly rewards companies that capture behavior first and figure out profits later. The goal is no longer immediate sustainability. The goal is psychological dependency, market dominance, and ecosystem control. Profitability becomes secondary as long as investors believe future monopolistic power is possible. Uber mastered this strategy better than almost anyone. It convinced the world that convenience itself was innovation. It convinced investors that losses were temporary. It convinced consumers that cheap rides reflected efficiency instead of subsidy. And for years, the illusion held together because everyone involved benefited from believing it. But eventually, every subsidized fantasy collides with reality, and Uber's story exposed something uncomfortable about the modern economy. Some of the world's most powerful companies are not built on solid business fundamentals. They are built on narratives, investor psychology, and the hope that future technology will eventually justify present-day losses. Because in Silicon Valley, sometimes the most valuable product isn't transportation, software, or even technology.